Now, Spar has posted its interim results. The group's earnings softened 0.4%, even though revenue remained steady. The group does note that pressure on consumer spending and low food inflation weighed on its top-line growth. Spar remains optimistic, though, for the second half as it expects margins to keep improving. And joining me now to unpack the group's performance is CEO Angelo Swartz. Thank you so much for your time, Angelo. Now, just characterize what this interim period was for Spar.
Thank you, and thanks for having me. It's been an interesting interim period for Spar. As you've mentioned, difficult trading environment, both in both of our main geographies, being Ireland and SA. So tough at the top line. Really proud of the work our teams have done to manage the bottom line. Soft top line performance, but in local currencies, both of our continuing operations growing positively. In SA particularly, we saw sales growth of 1.6% translate to operating profit growth of 5.5%. And if I exclude the costs related to the SAP implementation that we're about to embark on in our builded warehouse, that number actually grows to 7.5%. So despite the soft sales, really strong operating profit performance. And then in Ireland, really weak sales growth, slightly below last year, so minus 0.6 in local currency, but operating profit up slightly, up 2%, and PBT in Ireland up 10%, 10.8, which is really strong. So quite satisfied with those performances. Obviously, the interim period, I think what your viewers might find most interesting is our decision to dispose of our operations in the UK and Switzerland. I think after a very thorough review, probably for the last 12 months or so, management have been reviewing different scenarios in both those trading markets. And the decision we've made is it's best to exit, but with a priority on ensuring that all our people and their jobs are protected, and then also to protect the Spar brand in those markets. So engaged quite a way down in terms of engaging with buyers for those businesses, and really quite positive about the outcomes of those sales should they happen.
Well, let's delve into that strategic move. Of course, deciding to leave Switzerland and AWG in the UK, where now you basically have Ireland left in Europe. And I'm wondering, because also, I mean, you mentioned the softness that we saw in the numbers for Ireland as well. It has its own challenges. Why that decision then to hold on to that exposure?
I think Ireland is a relatively mature business in a mature economy where growths are generally slightly lower than we would see in emerging markets like SA. So it's a credible performance, largely impacted by some decisions we've made not to take on defensive positions on a couple of stores. But from our view, Ireland has scale in the local economy. It's a diversified business, not only exposed to wholesale, but also quite a big cash and carry component, as well as a strong food services component to that business, which we think makes it quite resilient. In terms of the future direction of the group, we really want to think of ourselves as a group dedicated to the service of independent retail. And with that in mind, the Irish business ticks the boxes in terms of our strategic view, both in terms of scale and strategic intent.
So would you say that your review of the European operations is now complete, or does this mean that there will be further and more detailed scrutiny on Ireland going forward?
No, I would say that both Ireland and SA become the heart of our business, and that they will both be core markets for us. Obviously, we have to complete the transactions in the UK and Switzerland, and we hope to do that fairly quickly. But Ireland definitely part of the core of our business and part of our long-term planning.
All right. Well, I mean, just as you know, one of the headwinds that Spar had really had weighing on it is the SAP rollout. At what stage is the integration and rollout of the SAP system, and are the costs now worked out through the system?
So in terms of SAP, we've only implemented it in the one distribution center so far. Our second biggest distribution center, the one in KZN. It has settled down nicely. From 2 turbulent years, this year we've been profitable in that business every month of this financial year, which is quite a turnaround. We aren't quite to the level of profitability we want to be in the long run, and where we've been historically in that business. Probably 65 to 70% of the way there. So still some upside in terms of that recovery, but the business no longer losing money, which is really great. And the SAP system really has settled down there. We are looking towards rolling out into our next distribution center at the end of January 26, which will be into our Builded distribution center, which is the smallest of our distribution centers. So we think we've contained risk there. It makes up less than 10% of the Builded business, and the Builded business is only 10% of the greater Southern African business. So really quite limited to around 1% of our sales. And I think that implementation will be the true test for the business as we roll forward.
Yeah, and I mean, there have been some moves that you made in terms of getting your balance sheet to a healthy position, a more sustainable position, and of course, with that comes then disciplined and prudent capital allocation. Now, in this point where you are trying to be as prudent as possible, where then does capital allocation? Where do you focus it on at this period?
Yeah, so I think capital allocation has been a big focus of ours as the newer management team. Looking at these investments in Switzerland and UK, really some of the decision making driven around what the most effective use of our capital is, and we don't believe that those markets are prudent from a capital allocation perspective. But more than that, I think what we really embarked on was a containment of the group's debt and reduction in the group's debt. And I think we've done a great job in terms of rationalizing the balance sheet and rationalizing the debt. Debt levels down year on year from just over 12 billion at this time last year to about 9.7 billion at the half year. And that's slightly up on our full year number to the end of last year, but there is a seasonal impact of Easter. So generally, we do have higher debt levels at this time of the year, and we expect a similar reduction in our debt to the end of the year as we saw last year. So continue to reduce the debt across the business. Really a big focus of ours. And really, the allocation of capital will be large portions of the capital will be invested in South Africa and Ireland for almost the whole. All capital invested will be in those two key markets, and a large portion of that will be skewed towards technology investments and investments in digitization and future-proofing the business.
All right. Just lastly, as we wrap up the conversation, I think we have less than a minute. Of course, you mentioned that South Africa is one of the geographies at the heart of Spar's operations. There is a tone of optimism for the second half of the year. What exactly are you banking on there?
I'm not banking on anything, to be honest. I think the business has shown some sales momentum in the first 2 months post our closing, which is gratifying. Not enough just yet, but headed in the right direction. Beyond that, I think I'm quite satisfied with the discipline on the expense line that we've shown in the year so far, and certainly over the last 18 months or so. So the discipline in the business supports more predictable outcomes. And then I think we have some definitive plans in terms of expanding our operating margin, and I think that will continue to improve.
All right. Well, thank you so much for your time and giving us more detail on those numbers that came out from Spar, Angelo. That was company CEO Angelo Swartz.